Okay, good day, audience. Today we are going to discuss IFRS Diploma past paper, June 2022, question number 1. June 2022, question number 1. Okay, this is related to consolidation. As you all know, there are total 4 questions, and you will have 4 questions in the exams. So, the first question normally is from the consolidation, right? I have pasted the past paper on my screen. And you can also take this past paper. You can also see this past paper on accglobal.com. On accglobal.com, this past paper is also available. Or if you want to take the picture from my screen, you can also take, right? Okay. And this PDF will also be available to you. I will also attach this PDF in my LMS, so you can also refer this as well, right? Now, let's start. Let me enlarge the screen. See, I have cut this past paper from the ACCA software, okay? See, this is the introduction. Alpha, a parent company with one subsidiary. Beta. So alpha is parent and beta is subsidiary. Alpha is parent and beta is subsidiary, right? And you have to prepare consolidated financial statement 31st March X5. Okay, this is the date. Now don't forget, this is not the question of income statement. This is not the question of income statement. This is not the question of SOCI. This is SOFP, statement of financial position, statement of financial position, right? So, and a statement of financial position is always as at. Hope you remember, it's always as at, not income statement. Yes, income statement is for the year, but SOFP is as at, right? Okay. Now, let's move on. So, we have already identified the accounting period. Now, they have given you few extracts. I'll discuss all of them. Don't worry, they are pasted on my screen. I'll show you. These are the few. And one thing which we have just identified is the accounting period. Accounting period is 31st of March X5. 31st March X5. This is your accounting date, okay? On which you have to make the SOFP. Now, see, they have given you the individual. They have given you individual companies. They have given you individual companies SOFP. They have given you individual. This is routine. Whenever you are required to make consolidated SOFP, they give you individual SOFP first. Individual SOFP of parent and subsidiary both, right? Okay. So now be confident and let's start the first exhibit. This is the first exhibit. Let me enlarge. It's now totally visible. You can see each and everything. Now, your accounting period, the date of your SOFP is 31st March X5. It's better you write it somewhere. Now, on 1st of April X3, Alpha acquired 80 million shares in Beta. Now wait, I request you please take the picture of this. See, you can take the picture of this individual SOFPs. See, S company has issued, you can see 100,000 shares. Total number of shares issued by S company was 100,000 shares, okay? But parent company acquired 80 million. So 100,000 means 100 million, 100,000 means 100 million here, because these are the 3 zeros as well, okay? So out of this 100 million shares, P company acquired 80 million shares. P company acquired 80 million. That means holding is 80%. That means P2S holding is 80%. Okay, now let's see. So P company acquired 80 million shares and gained control of Beta. And don't forget this date. This is the takeover date. Now, one important information. 1st April X3 is the acquisition date. 1st April X3 is the acquisition date, and your SOFP date is 31st March X5. So total 2 years gap between acquisition date and SOFP date. The gap is 2 years. 2 years. Don't forget. Okay, this gap is very important because in SOFP everything is as at. In SOFP everything is as at. So now, for many things you have to do 2 years cumulative transactions. You have to do cumulative transactions of 2 years because SOFP is as at, it's not for the year. Next, Alpha made a cash payment of 160 million to the former shareholders of Beta on first April. C, right? It is cash consideration 160 million, and definitely they have also made the entry investment debit and cash credit. They have made the entry investment debit and cash credit. Now, Alpha incurred acquisition cost of 10 million. I hope you remember. Nowadays, after the revision of IFRS 3, like 15 years back, 15 or 14 years back, IFRS 3 was revised, and you all have studied the revised standard. The revised standard says that all professional fees for the takeover goes in P&L immediately. So this acquisition cost must go in P&L immediately. But see what they have done. Alpha has incurred acquisition cost of 10 million and has presented the total cost of 170 million. See, 160 plus 10 as investment in equity. Wrong. They should have booked only 160 million as COI. They should have booked 160 million as COI. And this 10 million is not the part of investment. This 10 million is not part of investment. This 10 million should go in profit and loss account immediately. Parent company should book this in profit and loss account immediately, but parent company did not do this. So this is the mistake. Now let me correct it. Now, parent company forgot to book one expense of 10 million. Parent company, as the takeover is done by parent. So this is the expense of parent company. But parent company did not book this expense. Now look at me. Now when parent company will book this expense, the profits of parent company will go down. And when the profits of parent company will go down, parent company's retained earning will also go down. And when parent company retained earning will go down, consolidated reserve will go down. Okay. So you have to reduce consolidated reserve. Let me directly make a short correcting entry. Although entries are not required in this question, the correcting entry will be this. See, consolidated reserve debit 10 and investment credit 10. Investment in subsidiary credit 10. This should be the correcting entry. This is the correcting entry. Okay. This is the correcting entry, dear students. Okay. So when I'll be doing working for consolidated retained earning, I'll post it. Okay. So your COI till now, till the end of first paragraph, your COI is 160. But you know, one topic, I taught you one topic, different types of consideration, and hope you remember, my dear students, I taught you deferred consideration. Deferred consideration means unconditional promise to pay cash. Okay. A condition of the purchase agreement was that Alpha would make a further cash payment of 66.5 million to the former shareholders of Beta on 31st March X6. Now, please apply brakes. The takeover date is 1st April X3. All of you, please open your ears, open your eyes. The takeover date is 1st April X3. And we just promised them to pay this on 31st March X6. That means 3 years. 3 years. So, my dear students, what you have to do, you have to take out present value. As we have to pay this deferred consideration after 3 years. So what is the treatment of deferred consideration? We calculate the present value. Okay. And then we'll be doing unwinding of discount as well. Yes, this is basic thing. You studied in your F7 courses, F7 level courses, remember? So this is the basic concept. Now, Alpha Has not, see openly they are saying has not made any entries in its own financial statement in respect of deferred payment. So yes, we have to do it from zero. A suitable discount rate to use where relevant is 10% per annum. Okay, using the rate, the present value of $1 payable in 3 years time is approximately 75.132 cents. 75.132, not dollars, it's cents. So if I write simple, see, discount factor is, just write it like this, 0.75132. This is the discount factor. This is the discount factor. They have given in cents. They have given you in cents. So if you convert cents into dollars, if you convert cents into dollar, it will look like this. It will look like this. Okay. So we'll ready-made use. We will ready-made use this discount factor. We'll ready-made use this discount factor. Okay. Have a look. Now, let me show you the working. This is 66.55 million, 66.55 million. See this, look at here. Look at here. 1st April X3, 1st April X4, then 31st March X5. Yes, this is your year end. 31st March X5 is very important date. This is our SOFP date. But yes, we have to pay on 31st March X6. Okay. And I think we have to pay 66 point. Let me check. We have to pay how much? 66.55. What I'm doing is this 66550. I'm rating is it's originally 66.55 million, but you know the SOFP, the original SOFP in the question is not in millions. Original SOFP in the question is not in millions, it's in thousands. So I just adjusted like 3 zeros as well. Okay, so 66550. So first of all, you need to calculate the present value. You need to calculate the present value. Simple. Present value of deferred consideration is, the formula is simple. Simply write the cash flow 66550 times point, wait, let me check the 0.75132. Yes. Okay, so if you multiply, I think it's 60,000. Wait, 66550 times, yes, it's 50,000. Sorry. Okay, so the present value is 50,000. So you have to make the first entry here. You have to make the first entry here, which is investment debit, investment 50,000, and deferred consideration. You can write DC as a shortcut. I'm writing DC, deferred consideration credit 50. Okay, investment debit and deferred consideration credit. Now super concept. See, this is your year end. This is your year end. This year end 31st March X5, and this is acquisition date. So you have to, there are 2 years. There is a gap of 2 years between acquisition date and reporting date. So you have to take 2 years interest, the unwinding of discount, and you know the famous dialogues, the rate, the interest rate which is used for discounting, the same interest rate will be used for unwinding. So 50,000 times 10%. 50,000 times 10% is 5,000. So the entry will be, wait, this will be interest expense debit 5,000 and DC credit 5,000. Although the entries are not necessary, to be very honest, you can do without entries as well. There are no marks for entries. Okay. So now 50 plus 5, 50 plus 5, this will become 55,000. Now, as you know, that this whole game is compound interest game. This whole game is compound interest game. Don't forget. So in the second year, the outstanding amount is 55,000. In the second accounting period, the outstanding amount is 55,000. So 55,000 times 10% is 5,500. So the entry will be, and DC 5,500. Now you tell me, opening loan was 55,000 in the second accounting period. In the second accounting period, opening loan was 55,000 plus 5,500. It will make 60. Wait. Okay, 60,500. This is your year-end liability DC. This is your year-end liability DC, 60,500. Okay, so in your SOFP, you will write current liability of 60,500. Why current liability? Because you have to pay just within 12 months. You have to pay here. See, there is only 1 year gap. There is only 1 year gap between 31st March X5 and 31st March X6. Now the next question, sir, what about these, this interest and this interest, this interest and this interest? Obviously, now just use your brain. It was written clearly in the question, clear, that parent company has not yet recorded this complete transaction. So just think, when parent company has not recorded the loan, deferred consideration itself is a loan. When parent company has not recorded the loan, that means parent company has not recorded the interest expense as well. So now this is the expense of parent company. When P company has not yet recorded the expense, so obviously the profits of parent companies are overstated. So now when you correct this mistake, you will book expense in parent company's books. So parent company's profits will go down, and when parent company's profits will go down, parent company's retained earning will go down, and when parent company's retained earning will go down, consolidated reserve will go down. So you will reduce consolidated reserve by 10,500. See, this is cumulative. Okay, cumulative both. We are not doing income statement, we are doing SOFP. So your CR will be reduced by 10,500. Don't forget this. So you can have a look. And now you just predict the total COI, cost of investment. See, this is one investment, 50,000, and there was a cash consideration of 160 million, 160,000. So 160 plus 50, 210,000 is your total cost of investment. 160,000 was cash consideration and 50,000 is deferred consideration. Look at here. So your total consideration is 210,000 in this question, 210,000. Your total consideration is 210,000, right? Okay. Now, hope you remember in the SOFP question, you used to make packets: acquisition date net asset box and reporting date net asset box. Same you have to do here. Same thing you have to do here, right? Okay, let's start. See, this is the reporting date. These all things are reporting date. Can you see this? These all are 31st March X5, 100,000, 80,000 and 20,000. Can you see this? 180 and 20, 180 and 20. These all are reporting date. Now, where to get the acquisition date material? Look at here. Let me show you. See, on first, see the screen. On 1st April X3, Beta had retained earning of 60 million and other component of equity at 20 million. These are the acquisition date net assets. Okay. Obviously, you know the share capital never changes. Ordinary share capital never changes between acquisition date and reporting date. So here, this is the data. This is your data. This is your data. Okay. So now let me make the packets and then we can discuss. Now your acquisition date net assets. This is 1st of April X3 students. Now this is your reporting date net assets. This is 31st March X5. This is 31st of March X5, right? Okay. Now OSC retain earning, OCE. Okay. OSC retain earning and other component of equity. This is, my dear students, 100,000. So obviously this will also be 100,000. Retain earning here is 60 million, I just told you. And at the year end, it's 80 million, 80,000, you can see. OCE's acquisition date is also 20,000 and reporting date is also 20,000. If you want to take the picture, you can take. If you want to take the picture, you can take. This is the acquisition date and this is reporting date. Reporting date packet, we just picked from SOFP. Reporting date packet, we just picked from SOFP. And acquisition date packet, I picked from the notes. Now, hope you remember there was a very famous adjustment in F7 and SBR level, your financial reporting consolidation, that is fair value adjustment. Fair value adjustment. Now let's do it. Let's do it. See, there is a 2 years gap. You can see 1st April X3 to 31st March X5, 2 years gap. See this. On 1st April X3, that is the acquisition date. Let's start the fair value adjustment. Come on. On 1st April X3, the fair values of Beta's identifiable assets and liabilities were the same as their carrying amounts in the individual financial statements of Beta, with the exception of property, plant, and equipment. With the exception of property, plant, and equipment, which had a carrying amount of 160 million and a fair value of 190. Now, very simple. Carrying amount is 160, fair value is 190. So there is an upward. There is an upward. C is equal to A minus L. Hope you remember. There is upward revaluation of 30 million. There is upward fair value adjustment of 30 million. Now, as this is a plant, so yes, it's a depreciating asset. So you need to adjust some depreciation for future excess depreciation, right? On 1st April X3, the useful life of the plant was 5 years. The useful life of the plant was 5 years. The useful life of the plant was 5 years. The fair value adjustment should be regarded as a temporary difference. Yes, this thing I always teach in SBR. This is not in F7 level. This is SBR level thing. Defer tax on fair value adjustment. Use your mind. Click it. Defer tax on fair value adjustment. Let me tell you. As fair value adjustment is like upward revaluation. Fair value adjustment is like upward revaluation. Now listen the story. So when the value of the asset went up, you go to the tax department. You said, so we have got a benefit. our values went up, our values of properties or plant went up. So tax department will say, no, we don't want any tax now. Although you got the benefit, although there is an upward revaluation, which is a benefit, but it's an unrealized benefit. And tax department said that we don't charge tax on unrealized things now. We don't charge tax on unrealized things now. But yes, as the value has increased, so tax department said we'll charge tax in future. So you have to pay tax in future. You have to pay tax in future. So this is a taxable temporary difference. This is a taxable temporary difference. Hope you remember deferred tax on revaluation, the rules related to deferred tax on revaluation, deferred tax on revaluation. And as this is a taxable temporary difference, listen, as we have to pay tax in future, use your brain or recall this topic. As you have to pay tax in future, as you have to pay tax in future, so it's a taxable temporary difference. So there will be a deferred tax liability. There will be a deferred tax liability. Okay. So at the date of acquisition, you have to adjust this deferred tax liability as well. Now, for the purposes of computing deferred tax, the relevant income tax rate is 20%. The relevant income tax rate is 20%. Now, just I'm giving you 30 seconds or 1 minute to read it and think, make a strategy, relax and make a strategy. Let me do it for you. So now, you all know that this is C is equal to A minus L, and upward fair value adjustment is like upward revaluation. Listen, so when the assets value will go up, the net asset will also go up. When the asset value will go up, the net asset will also go up. So at the date of acquisition, first you will write fair value adjustment plan, and this is 30,000, right? But now use your brain. There is a 2 years gap. There is a 2 years gap. There is a 2 years gap. So, we follow the net asset approach in consolidation. Whenever I teach you consolidation, I teach you with this net asset approach, and net asset is always as at. So you have to adjust the second packet as well. So there is a finite life. There is a finite life of this plant is 5 years. So in these 2 years, in the next 2 years, see this, there will be some depreciation of 30,000 divided by 5 years. See, 30,000 divided by 5 years, this will give you 1 year depreciation, and multiply by 2. 30,000 divided by 5 years, it's 6,000, multiply by 2. So there is a 12,000 depreciation, right? So 30, see this 30 minus 12, the fair value adjustment here will be 18,000. Okay. Some people do it directly. Some students do this 18,000 directly. How? They just do 30,000 into 3 upon 5. 30,000 into 3 upon 5. 3 upon 5. 3 upon 5. Okay. Now listen. The next thing is defer tax on fair value adjustment. Don't take tension of this adjustment. Do it in a relaxed way. Do it in a relaxed way. I taught you this in SVR. Just use your brain. You just think at the date of acquisition, when the value of assets went up, you go to the tax department. You said, okay, please take the tax. Tax department will say, no, we won't charge tax now. No, we won't charge tax now. Yes, we'll be charging tax in future when you will sell this asset. So as we have to pay tax in future, there is a taxable temporary difference. There is a taxable temporary difference. And for taxable temporary difference, we book deferred tax liability. Now look at here. Remember, C is equal to A minus L. Deferred tax liability. We have to book a deferred tax liability. Look at here. So when you book a liability at the date of acquisition, when liability, see the liability goes up, the net asset will go down. The liability goes up, the net asset will go down. The net asset will go down, right? So deferred tax on FVA. Can anybody tell me what is the tax rate? Can anybody tell me 20% is the tax rate? So 30,000 times 20%. 30,000 is the upward revaluation times 20% is 6,000. And listen, listen. I have subtracted it. I have subtracted it. Why? See this. When liability goes up, net assets goes down. Liabilities goes up, net assets goes down. Okay. Now one more thing, the last thing. Hope you remember. Hope you remember. Just use your brain. This liability, see, as the carrying value of asset changed, see, this fair value of asset changed from 30 to 18. Open your eyes and move your eyeballs, please. 30 fair value, this plant value changes from 30 to 18 because of depreciation. So when this plant is going down, deferred tax will also go down. Deferred tax will also go down. Wait, giving you a short logic. Why did you book this deferred tax? Why did you book this first deferred tax? Because the value went up. You booked this deferred tax because the value went up. Yes. But now just think, if this value goes down because of any reason, if this value goes down, your deferred tax liability will also go down. Your deferred tax liability will also go down. So how to calculate this deferred tax liability at the end of year 2? Just multiply the tax rate with on this 18,000. Just multiply the tax rate 20% on this 18,000. So deferred tax on FVA will be 18,000 times 20% is 3,600. Okay. I'm giving you one more logic. One more logic. Although it is not needed, I have given you this logic in past as well, but okay, I can give you. Listen. You remember that when you were doing deferred tax, these three columns, carrying value, tax base, and TD. Remember, I used to teach you like this. Now just use your brain. At the date of acquisition, this accounting value went up by 30,000. At the date of acquisition, this accounting value went up by 30,000, but the tax department does not recognize this revaluation. The tax department does not recognize this revaluation. So just you think the tax base is 0. That means no change and no change as per tax department. But yes, in accounting, we took the carrying value up by 30,000. So this is the case of asset. Carrying value is higher and tax base is lower. There is a 30,000 taxable TD. There is a 30,000 taxable TD, right? At the date of acquisition. Now wait. After 2 years, 1 and 2, accounting value went down because of depreciation. Accounting value went down. In the first year, it's 6,000. And in the second year, 6,000 depreciation. So at the end of year 2, accounting value is 18,000. Accounting value is 18,000. This is remains 0. So 18,000 minus 0. Now your taxable TD is 18,000. Okay. And when you multiply the tax rate with taxable TD, it will be 3,600. See, I did this directly. I did this directly. Normally, this logic is no more needed. This is just for your connection. This is just for your connection. But now be very careful, as all of you are going to do the job in professional market. So don't be dependent on these spoon feeding things. Build your own concepts now. Build your own concept. Don't be so dependent. Okay. So now let me calculate these two packets. Let me calculate these two packets for you guys. This is 204,000 and this is 214,400. This is 214,400. Okay. And now if you take the difference between these two, if you take the difference between these two, so it will come as how much? This is S company's post retain earning. This is S company's 214,400 minus 204,000. 204,000. This is S company's post retained earning. This is S company's post retained earning. Please have a look. Please check it. Okay. Now we all know this packet. This packet will be used. This packet will be used in the computation of goodwill. One more thing I would like to tell you. Hope you remember the rules of consolidation if you have studied with heart. This and this, these two numbers will be added. These are the reporting date numbers. See, these are the reporting date numbers. So this will be adjusted in the above SOFP as well. This will be adjusted in above SOFP as well. Above SOFP, and let me do it for you. 18,000 and 3,600. Wait. See this. And here you will write deferred tax. Where is the deferred tax? Yes. Okay. 18,000 and 3,600. 18,000 and 3,600. Now let me calculate you the goodwill in 1 minute. 1 minute. Whenever you want to calculate goodwill, you remember there are two methods of in consolidation: full goodwill method and proportionate method. Full goodwill and proportionate. Read the method, please. Read the method, please. This is the method. The directors of Alpha measured the non-controlling interest in Beta on 1st April X3 at its proportionate share of the net asset. It's not full goodwill method, it's proportionate method. And there has been no goodwill impairment. Thank God, this is easy for you. There is no goodwill impairment. There is no goodwill impairment in this question. No goodwill impairment in this question. Okay. Let me calculate goodwill for you. COI. The first one is cash consideration. I think it's 160,000 is your cash consideration. Then we have deferred consideration. Deferred consideration was 50,000, my dear students. So this makes 210,000 is your cost of investment. I have already taught you this. Now, there is no need to add fair value of NCI at acquisition. You will directly like this, add less fair value of net assets of Beta. The name of subsidiary is Beta. Okay. Just pick the packet. The packet is 204,000. The packet acquisition date packet is 204,000. So you will write like this 204,000. And yes, we have obtained 80% shares. We have obtained 80% shares. So 204,000 times 80%. 46,800 is the goodwill. Very simple. 46,800 is the goodwill, please. $46,800 is the goodwill. The first thing is done. The first work. Now, still there are two components left, that is consolidated reserve and NCI. Consolidated reserve and NCI. Hope you remember these two. But before we do this, we have to read two major adjustments. We have to read two major adjustments. Sorry, three. See, this is your very simple intercompany sales, P2S or S2P sales. P2S or S2P sales, basic level adjustment. Come on, do it. Since 1st April X3, Alpha has been supplying. That means Alpha is parent company. That means P2S sale. Very good. P2S sale. That means P2S sale. Okay. Alpha has been supplying Beta with a product. Alpha applies a markup of 20%. Markup means profit percentage on cost, to its production cost when establishing an invoice price for sales of the product to Beta. On 31st March X5, use your brain. The inventories of Beta include 24 million in respect of these purchases. Very simple. I think you can do it yourself. It's an insult to solve this. This is very basic. Okay. On your request. See this. This is P. This is S company. So parent company sold goods to S company, but at the year end, S company has 24,000 of goods unsold. At the year end, S company has 24,000 of the goods unsold. So as these 24,000 goods are unsold, means not sold, so there is a URP in these inventory. There is a URP in this inventory. So let's calculate the URP. Now, very simple, SCP. Hope you remember this. SCP. Look at here. This 24,000. Listen to me. This 24,000 is the cost for S company. This 24,000, obviously it's the inventory of S company, so it's a cost of S company. But for this 24,000 is the selling price of P company. This 24,000 is the selling price for P company. Okay. So it's 24,000. Now you tell me it's markup or margin. Parent company uses markup. So in markup, cost is always 100. This is 20. Yes, 20. And this is 120. So you just shuffle it and calculate the profit. I think it's 4,000. Yes, it's 4,000. So that means there is a profit of 4,000 included in this. There is a profit of 4,000 included in this, and this profit is unrealized profit. This profit is unrealized profit. This profit is unrealized profit. Okay. So within a short, you calculated URP. Within a short, you calculated URP. Okay. Now, as this is P2S sale, come on, start. As this is a P2S sale, so in P2S sale, URP is booked by parent company. So it is included in P company's profits. And when it is included in P company's profits, so it is included in your consolidated reserve, parent company's retained earning and consolidated reserve. So you will reduce consolidated reserve. You will reduce your consolidated retained earning, number one, and also the group inventory. You will reduce the consolidated retained earning and also the group inventory. Also the group inventory. So let me reduce the inventory first so that we don't forget. Okay. But yes, we have to reduce the consolidated reserve as well. Once I'll come to the consolidated reserve, I'll do it. I'll do it. Now it's now the two major adjustments, and then the question will end. Two major adjustment. In this question, there is IAS 23. I have taught all of you this. IAS 23, the name of the standard is borrowing cost. The name of this standard is borrowing cost. Let me explain. You know, borrowing cost means cost of borrowing funds, cost of loan, and it means interest. So normally in 99% cases, interest is always an expense. In 99% cases, interest is an expense. But yes, this IAS allows us to capitalize the interest. That means now you can make the entry as interest is your asset now. You will book PPE. You will book PPE debit and cash credit. Now, no need to book interest expense debit and cash credit. Okay. But there are certain conditions. Hope you remember this IAS. I'm not going to teach you this IAS from scratch now. Hope you remember this IAS, that you can only capitalize borrowing cost if you are buying a qualifying asset. A qualifying asset is an asset which takes a qualifying asset is an asset which takes substantial period of time to complete. A qualifying asset is an asset which takes substantial period of time to complete. Substantial period of time to complete, right? Okay. And one more thing. Hope you remember when I taught you IS 23, I taught you the whole conditions. When to start capitalization and when to end capitalization. When to start capitalization and when to end capitalization. To start capitalization, first of all, you must have taken the loan. Yes, you have already taken the loan. Plus, you have to start the work as well. You have to start the work. The date you will start your construction, from that date, you can capitalize. And yes, the date on which you complete the date on which you complete your the date on which you complete the project, you will simply end this capitalization. Okay. So from the start of the contract to the end of the contract, yes, all the other areas of interest will go in PNL. All the other interest will go in the PNL. I repeat, the day you will start construction, you will start capitalizing the borrowing cost, that means interest. And the day this project will be finished, this project will be completed, you will stop capitalizing interest. After that and before that, everything will go in PNL. This I have taught you. Yes, I have taught you in class IS 23. And you all must have your exam folder. Keep your exam folder with you so that you can simply see the summaries in seconds. This is the key. Read the adjustment, please. Read the adjustment. Okay, let me read. On 1st August X4, Alpha began to construct. Alpha is parent company, so nothing to do with subsidiary. It will only hit your consolidated retained earning. Okay, it's parent company's transition, and now it's the application of IFRS. On 1st August X4, Alpha began construction started. Important point. to construct a power plant. The construction cost was 60 million. The construction was completed on 30th November X4. 30th November X4. See, this date is also important. The starting date and ending date. Starting date and ending date. So starting date is August, ending date is November. See the count the months. August, September, October, and November. August, September, October, and 4 months. 4 months. Only 4 months capitalization is allowed. The plant was available for use from that date. Following a formal opening ceremony, the plant was brought into use on 1st January X5. It doesn't matter. It doesn't matter. It was available. You have to see the availability of available for use. You start depreciating. You start depreciating your things the day when it is available for use. Apply the brakes first and go to IAS 16. From which date you start depreciating asset? Ask yourself, from which date you start depreciating asset? Start depreciating your asset. The date when it is available for use, not the date when you start using it. This is very technical issue. In IAS 16 says you start depreciating your asset from the date it is available for use, not the date you start using it. This is very technical issue. Okay, so available for use date is 30th November X4, or you call it 1st December. It's same thing. 30th November X4 or 1st December. Alpha estimated the useful life was 10 years. Okay, this is for depreciation. On 1st July X4, Alpha borrowed 60 million to finance the construction of the power plant. The interest payable on this borrowing was 8% per annum, payable in arrears on 30th June each year. On 30th June. Okay. On 31st March X5, the property, plant, and equipment of Alpha incorrectly included 62.01 million in respect of the power plant, made up as follows. There are two mistakes. There are two mistakes in this working. There are two mistakes. The first thing, wait, you took loan in July. Let me write the whole July, August, September, October, November, December, Jan, Feb, and March. See, this is your year end. March is your year end. March is your year end. So that means you took loan in July. You took loan in July, and from July to March, there are total 9 months. Okay. So in this accounting period, you utilized the loan 9 months. In this accounting period, you utilized the loan 9 months. Now, the real thing. For how many months you can do capitalization? You can do capitalization. Should I tell you? Wait. The work began on 1st of August X4. So from August, you started the work. From August, you started the work. My dear respected student, from August, you started the work. So August, September, October, and November. That's it. On November, you finish the work. Only 4 months interest you can capitalize. Only 4 months interest you can capitalize. That's it. Not more, not a single day more. Not a single day more you are allowed. Not a single day. Only 4 months. Now, what this stupid guy has done, see, finance cost of loan taken out to, see, he capitalized 9 months. See this, he capitalized 9 months interest. So this is the biggest mistake. This number is wrong. This number is wrong. This 3600 is wrong. This 3600 is wrong. This is wrong. This is wrong. So when he capitalized wrong interest, that means this total number is also wrong. The figure of 63,600 is also wrong. Now the value of total asset is wrong. So the future depreciation will also be wrong. The future depreciation will also be wrong. Okay. Now, as the number is wrong, as the total capitalized cost is wrong, so obviously the future depreciation is wrong. One more blunder this idiot has done. One more blunder. You know, the asset was available for use from 30th November. See, in the question it is written, the plant was available for use from that date. That means after November, it's 1st December. So plant was available for use from December. So you have to depreciate December, January, Feb, and March. You have to depreciate 4 months. You see, at the end of November, work has been completed. The plant is ready. Now, from the very next day, see the question. From the very next day, it is available for use. From the very next day, it is available for use. From the very next day, it is available for use. So yes, before the year end is 31st March. So you should depreciate it for 4 months. You should depreciate it for 4 months, my dear students. Okay. You should depreciate it for 4 months. But what he has done, see, he has depreciated only for 3 months. 3 upon 12. He has depreciated only for 3 months. This should be 4 months, 4 upon 12. Okay. So this depreciation is also wrong. So finally, this last number is wrong. Finally, this 62010 is wrong. There are two mistakes. Number one, he overcapitalized the interest. He should have capitalized only 4 months, August, September, October, and November interest. He capitalized total 9 months interest. Okay. Secondly, he should have depreciated for 4 months. He did depreciate for 3 months. Okay. Now you take the picture of this so that I can do the correct calculation, and I'll make one entry and everything will be finished. See both errors, this error and this error, both error is related to PNL as well. Okay. Both error, because he overcapitalized the finance cost. Overcapitalized means the interest which should have gone in the PNL, the interest expense which should have gone in the PNL, this guy booked it as an asset. The first mistake. Second, he calculated wrong depreciation. Also, depreciation also goes in PNL. So both of these mistakes will hit the PNL. Okay, I'll do it. Both of these mistakes will hit the PNL. Both of these mistakes will hit the PNL. Will hit the PNL. Okay. So you please check, you please take the picture of this. I'll calculate it from zero. Very easy. Let me do here. $60,000 is the cost of power plant. Now add capitalized borrowing cost. Borrowing cost. How many months interest can you capitalize? Tell me. Only 4 months. Only 4 months. So the loan was 60 million, 60,000 times 8% into 4 upon 12 times 8% into 4 upon 12. It's 1600. Okay. So the correct amount is 61,600. The correct amount of asset is 61,600. Okay. This is I'm directly doing the right working. The correct working I'm doing now. Less depreciation. Wait. This is the correct cost, 61,600. The life is 10 years. So divide by 10 years. And how many months depreciation you want to book? How many months? 4 months. 4 months, not 3 months. So times 4 upon 12. Okay. 61,600 divided by 10 into 4 upon 12. 59547. 59547. Okay, so this is the correct carrying value. This is the correct carrying value of plant, right? At 31st March, obviously X5. Now, what is the wrong carrying value? See the question. You have taken the pic. Let me show you. The wrong carrying value is 62010. Look at here. The wrong carrying value is 62010. The wrong carrying value is 62010. Wrong of plant is 62010. Okay. Now, how much we have to reduce? Wrong carrying value was 62010. Correct is 59547. So we need to reduce the carrying value. Obviously, if you want to correct this error, if you want to, this is the wrong amount, this is the correct amount. Okay. So you need to bring your plant from 62010 to 59547. How much is the difference? How much is the difference? It's 2463. 2463. Okay. Adjustment. And how you gonna adjust it? I already told you that all the two mistakes. The first mistake was related to interest. That is also expense. The second is related to depreciation. That is also expense. So obviously you will adjust this. You will adjust this in P&L. Let me give you a shortcut entry, although entries are not required at all. The shortcut entry will be P&L debit 2463 and plant credit 2463. This is the shortcut entry. That's it. Done. And with the means of P&L debit, as this transaction is related to parent company Alpha, you go and read. This whole transaction is related to parent company. Whole transaction is related to parent company. That's why this expense is going to hit the consolidated reserve. This expense is going to hit the CR. Okay. And obviously the other thing will hit your plant. The other adjustment will hit your plant. The other adjustment will hit your plant. Let me reduce the plant so that we don't forget. It's, see this, minus 2463. Okay. These all things you have to adjust in the final SOFP. Final SOFP. Yes, one thing in the CR and the other thing is in the final SOFP. Other thing in the final SOFP. Okay. So one more adjustment done. One more adjustment done. One more adjustment done. Now we have done almost all adjustment except one last. Except one last, which is related to convertible loan notes. Which is related to convertible loan notes. Convertible loan notes. Okay. You remember the convertible loan note thing in IFRS 9? IFRS 9. Okay, let's start our last adjustment. It is written on 1st of April X4. On 1st of April X4, Alpha borrowed $80 million. The interest payable on this borrowing is 5%. The interest payable on this borrowing is 5% per annum. Payable. See, this is the physical interest. You remember the coupon rate, physical. This is the physical payment which we have to make every year. Listen, payable in arrears on 31st March each year. Alpha recorded the first interest payment of 4 million on 31st March X 5 years. They have paid the physical interest, the first physical interest they have paid. No issue. Yes, it is normal as a finance cost and included 80 million in respect of this borrowing as a long-term borrowing. Now, see, this guy has booked, this guy, the parent company, this transaction is related to parent company Alpha. See, this transaction is related to parent company Alpha. So again, it has nothing to do with subsidiary company. It has nothing to do with subsidiary company. So everything will go in the consolidated reserve again. Everything will go in consolidated reserve again. Okay. And they have recorded the complete transaction as a loan. They have booked complete transaction as a loan. They have booked complete transaction as a loan. Okay. Now, the principal sum of 80 million, the principal sum of 80 million together with any accrued interest due is repayable on 31st March X9, 5 years. See, the story started. The loan was taken on 1st April X4. The loan was taken on 1st April X4 and this loan is going to mature on 31st March X9. Count the years. There are total 5 years. Okay. The lenders mean the one who gave us loan. The lenders means the investors. The lenders means the investors have the option to receive equity shares in Alpha at 31st March X9 as an alternative to receiving repayment of the principal amount. If this option were not available, then the lenders would have required an annual interest rate of 7% per annum. See, this is convertible loan note. See, the lender have the option, in convertible loan notes, normally the lenders have the option of shares. Okay. And in the end, they have clarified you that if this option were not available, had there not been this option, then the normal loans in the market, without such conversion options, the rate is 7%. So this is the market rate. Okay. Now, when I taught you this topic, I taught you like this. Listen, in the market, the interest rate is 7%, but these guys accepted just 5%. See, in the market the interest rate is 7%, but these lenders have happily accepted 5%. Why they accepted 5%? Because this is not a normal loan. This is a convertible loan with conversion options. That's why they accepted it. Now, if you have done the F7 and all levels, you remember this is the routine question of F7 final account as well. That normally they book convertible loan note wrong. They treat the complete amount as loan. In reality, in convertible loan, you have to break up in debt and equity. You have to break the transaction in debt and equity. Okay. So now let's do it. They have not done it. Why? How come I know? Because they have written, see, 80 million and included 80 million as a long-term borrowing. See, complete 80 million they have recorded as a long-term. Complete 80 million as a long-term borrowings, right? So let's do it now. Wait, there are they have given you discount factors. I hope Now you are the students of IFRS Diploma. You remember the annuities. You remember if there are same cash flows. For example, see, year 1, year 2, year 3, 10, 10, 10. If the cash flows are same and they are recurring in equal interval of time, such series of payments are called annuities. This is 10, this is 10, this is 10, same payments and same interval of time. Such series of payments are called annuities. And for annuities you have to use annuity factors as well, separate annuity factors as well. Hope you remember the whole story. This is totally irrelevant thing, making you fool. Coupon, you never do discounting on coupon rate, you do it on market rate. You always do discounting on market rate. You must know this. Now you are giving the paper. Be very honest. You are giving the paper now, so you must know these tactics of examiner, that we in our SOFPs we record all liabilities and all assets, all loans and all loans receivables and payables on using market interest rate. We do discounting using market interest rate. Okay, so now this is the cumulative present value. Cumulative present value means this is annuity factor. This is annuity factor. This is annuity factor. Look at here. This is annuity factor. And this is just discount factor. Present value of $1 in 5 years time. This is discount factor and this is annuity factor. So for as there will be 5 interest, as there will be 5 same interest payments, as there will be 5 same interest payments, so you have to apply annuity factor for interest. And as there is only one principal payment, there is only one principal payment, that's why you will be doing only one discounting for the principal amount. And I'm sure you know this thing. This is very, I gave you many classes for this, whole complete class on convertible loan note, whole complete class. Now what are the rules? Rule says, IFRS says that first of all, treat this transaction as a complete loan and identify all cash flows. So the cash flows are principal and interest. Plot those cash flows and then can do discounting. Take the pic of this. So that I have to move the screen. Okay. See this. Just for your easiness, I'm doing this. 1, 2, 3, 4, and 5. The loan is, I think, 80 million. 80,000 times 5%. 80,000 times 5%. 4,000. 4,000. 4,000. 4,000 and 4,000. There will be 5 interest payment of 4,000, and at the end of year 5 there will be a principal of 80,000. Okay, there will be a principal of 80,000. Simple. 80,000 was the loan amount. Coupon rate is 5% physical interest, so 80,000 times 5% is 4,000. Now you have to calculate the present value of all. So how you are going to do it? Present value of interest payments. See this. As there are interest payments, as there are 5 interest payments, and they all are with equal interval of time, so this is annuities, and you have to use the cumulative discount factor. Let me see in my question. It is 4.1. Yes, 4.1. Okay. So, and then present value of principal loan. principal loan, which is 80,000, and a single discount factor will be used, and which is 0.713. So please add these two. Please add these two. This will be 73440. Calculate the value and add these two. This will be 73440. This is present value of liability element. Okay. Now, you remember I taught you in this way. That means if you calculate the present value of all future cash flows, it is 73440. But you know how much initial investment? How much initial investment did the investors did? They paid us 80 million. They paid us 80 million. They just think they paid us 80 million now. And if you treat this transaction as pure loan, they are just getting 73440 in terms of present value. So the NPV is negative. The NPV is negative. So this is a loss deal, but still they are happy. Why they are happy? Because they have just not invested in loan. They have invested in convertible loan notes. So the difference is equity option. The difference is equity option. How much is the equity option? Tell me. This will be 6,000. Wait. $73440 minus 80,000. 6560. Yes, this is the equity option. This is the equity. So now let's make the entries. Let me explain you. This is 1st of August X4, and my dear students, this is 31st of March X5. Okay. Although I'm making the entries, but in the examiner solution, there are no entries. Okay. But yes, I have taught you through entries, so it's easy for you to understand. You should have made the entry initially bank debit. Wait, let me make. Initially, you should have made the entry this. Bank debit 80,000. Loan credit. Loan, how much is the loan? 73440. Okay. And equity option, which is OCE. Equity option, you can write OCE. That's also correct. Equity option is 6560. Okay. This should be the entry. You should make this entry. But you know, these people, what they made the entry, they treated the complete transaction. You go and read the adjustment. They treat the complete transaction as loan. They treat the complete transaction as loan. Okay. So now you remember the 3-step entry: correct entry, wrong entry, and now tell me what is the correcting entry. The correcting entry will be the debit loan 6560 and credit OCE or equity option, whatever you feel comfortable. So this is the first correcting entry. This is the first correcting entry, my dear student. This is the first correcting entry you have to make. This is the first correcting entry you need to make. Now, second entry. Your initial loan is 73440. Your initial loan is 73440. Now you use your mind. You know, you calculated this 73440. Student, look at me. You calculated this 73440 through discounting. You calculated, see the discounting. This is the discounting. The present value working is always discounting. You calculated this 73440 through discounting. And this is a very famous dialogue. Whatever rate you used to calculate present value, the same rate you used to calculate for unwinding of discount. Remember? So the rate was 7%. So 73440 times 7%. The entry will be interest expense debit 73440 times 7%. Come on, do it. 73440 times 7%. It's 5141. 5141. Interest expense debit 5141. Physical interest was 4,000. Physical interest was 4,000. And the difference will be added in loan. The difference of 1141 will be added in loan. So this entry, this interest entry, they should have made. This interest entry they should have made. But you know what they did make? What they did make? Go and read the adjustment. I request you, I told you to take the picture. They just booked the physical interest. They just booked the physical interest, which is this. Okay. So now the first entry they should have made, they made the second one. Now let me make the third entry. Let me make the third entry for you guys. And this is going to be interest expense debit. How much? 1141 and loan credit 1141. Okay. So end of the story is these two entries, this entry and this entry, the two right tick entries. The two right tick entries are the end of the story. This entry and this entry, these two entries, if you post just these two entries, stories end. That's it. That's it. If you post these two entries, the stories end. And yes, this is the way I taught you the final account question, many final account question. If you have studied F7 level IFRS 9 with me, I taught always teach in this way. Okay, now wait, now hold. See, in the first correcting entry, you reduce the loan, debit loan, and in the second, you credit the loan. Now let's post in the loan accounting first. Okay, on the balance sheet first, loan 65 less 6560 plus 1141 less, see this less 6560 plus 1141. Okay, this is, you have to adjust in the loan. And now this thing will go in OCE, this thing will go in OCE, and this interest expense will go in CR. See, the interest expense is an expense, it's a P&L thing. Interest expense will hit profit, and profit will hit retain earning. Retain earning will automatically hit consolidated reserve. Okay, right? Because this adjustment is all related to parent company. This adjustment is all totally related to parent company. Okay, now we have done everything. We have done everything. We just have to calculate now consolidated reserve and NCI. That's it. That's it. We have to calculate consolidated reserve and then NCI. Let me do it for you. Let me do it for you. Okay. I hope you will help. This is consolidated retained earning. First of all, we'll write parent companies retained earning. Parent companies retained earning. Okay. Students, please let's be active. Be active. Now it's not difficult. We have done everything. Parent company's retained earning is how much? 160. Parent company's retained earning is 160,000. And S company's post retained earning is this C. S company's post retained earning is 10,400. We have calculated through the packets. Remember, see this, we have calculated through packets. So parent company's retained earning is 160,000, 160,000, and S company's post retained earning is 10,400. Now, S company's post retained earning is 10,400. Use your brain. Do we own 100% of S company? No. Do we own 100% of S company? No. We only own 80%. So we always multiply it by the holding percentage. So 10,400 times 80%. 10,400 times 80%. 8320, right? Now, many things we have to post, right? Let's start from the scratch. The first thing we have to post is unwinding of discount deferred consideration. Unwinding of discount, 5,000 plus 5,500 less unwinding of discount deferred consideration DC. This was 10,500. Remember the cumulative amount. Then we have then we have the second thing is URP. Yes, less URP to S sale. URP to S sale, it was 4,000. Remember? Then we have one adjustment of power plant, less plant adjustment. I think it was the plant adjustment was 2463. Yes. Carrying value IS-23 was also there. It was 2463. It was 2463. Then my respectable student, less there is a interest on convertible loan note. See this one, 1141. Just read it. Look at here. Less interest on convertible loan. This is 1141. Okay. So yes, we have done. Wait. Parent companies, subsidiary company post. Yes, done. We have done P2S sale URP, unwinding of discount, done. We have done the convertible loan note and power plant adjustment. I think we have done all of them. One thing we forgot. Yes, there was an error in the question in the starting. You know, the professional fees, they have wrongly included the professional fees in COI investment. And you know, professional cost of takeover is always expense. Professional cost, go and check the first paragraph, less professional cost of takeover, 10,000. Yes, it's an expense. Everything is done. Now let's do it. One 40216. Let me double check. Yes, it's correct. This is consolidated reserve. This is consolidated reserve, students. Now we have to calculate NCI. We have to calculate students NCI. We have to make. There is no full goodwill method. There is no full goodwill method. It's proportionate method. It's proportionate method. And how we calculate NCI in proportionate method? Simple, simple. Listen to me. S companies, listen, S companies, fair value of net assets at reporting date multiply by the NCI holding percentage. That's it. Let me show you. Let me show you. See, can you see this packet? Just this packet. See, this packet, S company's reporting date net asset multiply by 20%. That's it. That's your NCI. No need to do detailed process. This is closing net assets of S companies, closing adjusted net assets of S company multiply by holding percentage. That's it. This is the NCI. It's 214400, I think. Wait. Yes. Multiply by obviously 20% because our holding. It's 42880. It's 42880. 42880. 42880, please. Now there is one more reserve in this question. OCE. 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 What are the rules? The rule says for all reserves, retain earning, all reserves, right? P companies complete reserves. P companies complete reserves. Complete OCE. What is the OCE of P company? P company's OCE. P company OCE is, see this, 70,000. P company's OCE is 70,000. 70,000. Yes. There is one adjustment. There is one adjustment of convertible loan. Remember 6560. There was an adjustment. Wait. Let me show you. I have the evidence. See 6560. This adjustment. See students, this adjustment we just did. 6560 we added. And now S companies, always S companies post OCE. S companies post OCE. There is no post OCE. There is no post reserve for OCE for S company in this question. Why? Acquisition date, see the question if you have. Acquisition date OCE was 20,000 and reporting date was also 20,000. Let me show you. See this. See this. See these packets. See this. Acquisition date is OCE 20 and reporting date is also 20. See, these both are 2020, same. So no change. So nothing will come. Nothing will come. So this is the OCE. It's 76560. 76560. Okay. So I have calculated goodwill for you. I have calculated NCI for you. I have calculated OCE for you. Now you have to do simple cancellation and then you can do adding together yourself. You are no more kids at all. Don't even think of that. You can do it easily. Even after doing so many past papers of F7 and SBR, this is also very easy for you. Okay. So you can try it. Adding together. I hope you understood the question, right? Thank you. Take care.